Hello, everyone. Greetings. Welcome to Tech Talk, where innovation meets strategy. Firstly, I would like to thank our media partners and sponsors K Media Marketing, Borneo Post, Utusan Borneo, Oriental Daily, Sihua Daily, and TFM. Today's broadcast, MAXAI, presents executive and employee wealth management strategies, dives into how Nasdaq private market wealth strategies are transforming the way executives and employees think about their financial future. From unlocking liquidity to creating smarter pathways for long term wealth, we will unpack strategies designed to help leaders and teams maximize value in today's fast changing market. And we have with us today Dr. Ahmad Moradi, the CEO of Maxwell Rand. And over to you, Dr. Moradi.
Greeting everyone. Thank you for having us. Welcome to our weekly show, Tech Talk, powered by Borneo Post and K Media and the team. On behalf of the crew, we want to thank you for joining us for these sessions. As usual, our objective is to inform, communicate, and educate our audience so they can make informed and strategic decisions. Today's conversation is extremely valuable for a lot of people that they work in various part of the segments and from range from executives to the employees that they're looking to build wealth management strategies. But more importantly, one of the areas that today we are going to be talking about, at least today, is we're going to be sharing a few videos with you to give you third-party opinion and also bring in that information to you so therefore you can make an unbiased decision. But the goal is wealth management. That's really it is, because we all working in this market in today's evolving financial landscape, that the path of wealth creation for executives and employees differs significantly between private and public companies. While public companies are offering liquidity, market-driven valuations, standardized compensation structures, private companies offer different sets of unique opportunities for equity participation, for long-term growth alignment, and strategic wealth building prior to an IPO or exit. So understanding these differences are critical not only for maximizing financial outcomes, but also for shaping retention strategies, incentive programs, and overall corporate culture. Diversity of the culture now is coming from multinational, multi-ethnical, and multi-geo IPs. So the most important thing as we are educating you is a tailored approach to wealth management that can bridge the gap between immediate financial rewards and long-term wealth preservation, empowering leaders and employees to thrive regardless of their corporate structure. So with that in mind, we wanted to share a few videos with you and give you some general idea that what we talk about. So let's take a look at the first video in here, and then we go from there.
KKR is known for a deal they did in 1998. And this was when they bought RJR Nabisco with a lot of leverage. This was covered in the book, Barbarians at the Gate. In the video we're about to watch, the co-head of global private equity at KKR talks about other value creation strategies besides adding leverage. In fact, he talks about 5 of them. Let's listen.
The private markets today have a stronger portfolio. And then on top of that, private market investors can pick their assets, choose their management teams, pick their entry and exit points, customize their capital structures, design really sophisticated incentive plans, and drive value creation.
Pete talked about 5 value creation strategies. Number 1, picking your assets, figuring out which companies are good that you should buy and which companies are bad that you should avoid. Number 2, talked about choosing the right management teams, conducting detailed due diligence on private companies to ensure that they have management teams that you can trust, as well as management teams that have the ability to perform well. Number 3 was being able to pick your entry and exit points. Now, for private equity funds, this is a little more difficult because private equity funds have a specific time period and need to deploy investor capital and then give investors back their capital before the time period is complete of the fund. And number 4 is to customize capital structures. This is not just debt and equity, but could also include convertible debt, preferred shares, and other instruments. And number 5 was designing sophisticated incentive plans. This is to make sure that management's interests are aligned with yours as the investor. And do you know what else you can do to make sure there's an alignment of interest? Well, let's see what Pete has to say about that.
So sharing information, teaching about the business, driving employee engagement, teaching financial literacy, that hard work has to go together with employee ownership. Otherwise, it's not going to work. The magic is getting employees to feel respected, trusted, valued, like they're more than just dispensable widgets.
So to really create alignment of interests as an investor, if you could actually have employee ownership, so not just the management team, which has aligned incentives and ownership of the company, but if you can also allow for employees, all employers, not all employees, most employees, to invest alongside you as a private equity firm, this will truly create alignment of interests and help employees feel valued. So in addition to designing sophisticated incentive plans for your management team, investors can give employees the opportunity to also own the company. And so that your incentives are aligned not just with the management teams, but with the employees. So that when value is created for you, the investor, it's created for the management teams and employees as well. So we've got
Dr. Moradi, we lost your audio. Can you unmute yourself, please? Thank you.
Sorry about that. So the essence of this presentation to you is that we value employees along the side of the management, because management cannot perform their tasks and duty without the employees, and employees can rely on the management. So they are pretty much like a yin and a yang of an organization, if you will. And if they don't collaborate, and if there is not a cohesive balance from a wealth management, then that structure crumbles. And that structure not only as a private company crumbles, but also in the public companies. So therefore, one of the areas that we always try to tell you is value the employees, cherish them, help them to grow their wealth strategies, let them invest with you, not only their time, but part of their capital, that you can help them to build wealth strategies, not only for themselves, but for their families and children that they're going to become the beneficiary of that services. Now, in this next video, we're going to talk about a little bit of how NASDAQ and private market and the process of this procedure can come together. So this is a video shared by us from NASDAQ Private Market, and we're going to share it with you. Oops. Okay, I think this video cannot be
played. I believe
Right.
it's rights management.
right. So let's take a look at it one more time, and if we cannot do it, then we move to the other topics. Let's see.
KKR is
You're muted, Dr. Moradi.
Yes, the video, unfortunately, because of its right management and GeoIP, we cannot play that for you. So let me explain a little bit about it, and then I summarize it based on that kind of thing. Private companies normally have a greater value in the private equity market these days. For example, one of the proven model that now has been established since 2011 is by NASDAQ. NASDAQ decided that obviously, you all know NASDAQ Global, so that means that you can buy, sell, trade shares since 1971. So this is nothing new about public market. But the essence of the Job Act back in 2011, during Obama administration, and during the Job Act in United States, created an opportunity that it manifested itself all around the globe, in Europe, in Asia, etc. Because not every company can qualify to become a public company. So small businesses, they either look at ways for liquidity, or they're looking for cash flow, or they're looking for asset or expansion or sales and so forth. This kind of models right now have created a little thing that I present here to you as a little presentation. Hopefully you see it. If I don't know. Yeah, here it is. Okay, it's a little screenshot, but it gives you a general idea that companies start from what we call a concept. They move to the seed, to development, to growth, expansion, and obviously to maturity. These phases, it doesn't matter what part of the world you live, what kind of business you run, you always start with that procedure. You think of an idea, right? You go and talk to different people, maybe families, friends. You ask for some seed capital maybe, and then you use that seed capital to start doing your development. You focus on your business, and over the time, this little branch or the seed that you have grown, now it becomes into a growth strategy, and now you need additional capital, finance, and to expand. And also, while those employees, along with the management, they are working with you, then they are giving you the ability to establish the protocol that you need to get into the stage that you can monetize it. Call it IPO, okay, or exit strategy. In other words, most entrepreneurs around the globe, their hope is to become the next Elon Musk, okay, the next Larry Ellison, the next Bill Gates, etc., etc. So, and also market has become extremely competitive now. There are, for instance, in one of my companies right now, as I'm explaining to you, we have for one of our companies over 350 application for job, okay, for over hiring a group of people. So what that tells me is that as Silicon Valley, for instance, are terminating a lot of people, like Salesforce last week fired 8,000 people. Now, these people, obviously, they need to build their own projects, programs. So market becomes more saturated, more competitive, and then the best of the best become the survivors. So with that kind of a setting right now, one of the areas that we are looking at again is to be able to provide a video again. Take a listen to this one to understand a little bit more, and then I'll carry on.
So the private equity industry is trying to raise capital from the private wealth channel, from individual investors. Is this good or is this bad? Well, let's first discuss why it's good. One could argue that there's a need for democratization of private equity. In other words, to give individual access to these investments that normally have been reserved for bigger investors. Bigger investors such as institutional investors like pensions, endowments, sovereign wealth funds, and family offices. By giving the individual investors access to this asset class, one could make the argument that they have access to higher returns and access to more diversification for their portfolios. So let's look at the bad. Private companies are private by definition. So they are not liquid. They're illiquid. But individual investors want liquid products. The industry has created many different structures to make these illiquid assets liquid for investors. We were interested in learning more. And so we interviewed many private equity firms around the world, and we created a video on YouTube called Liquid Private Equity. It's 15 minutes long, so please check that out if you want to learn more about the structures. To get from a illiquid asset to a liquid structure, there are many layers in between, which can constitute quite a lot of fees. And so the question for the end investor is, after fees, are the returns of private equity really something you want to put in your portfolio? In other words, do the returns in private equity exceed the returns in the public markets? I would argue if you're looking at that, you need to figure out what is your public market benchmark that you're looking at. Is it the S&P 500? If so, that might be biased by some big US tech companies. Is it the Russell 2000? Is it the MSCI World Index? What is that benchmark that you're comparing to? And when you're looking at your private equity benchmark, make sure when you're looking at figuring out what private equity returns are, that you're including all private equity funds and there's no survivorship bias. In other words, that you're not leaving out private equity funds that went to zero. So another bad part is the actual liquidity that these liquid vehicles give. There is a potential that investors will be gated from getting their money back. Let me explain. Every quarter, there's usually a redemption gate of 5% of net asset value. And so, if things go south, if there's a recession for some reason, or if something happens to the portfolio and all of the investors want their money at the same time, well, not all of the investors will be able to get their money. And so, is the fact that the private equity industry is raising money through the wealth channel, is it good or is it bad? Well, as an individual investor, you need to do your own due diligence, understand the pros and cons, and figure out if these vehicles fit.
Therefore, when we are talking about making decisions, in everything we do in life, there are pros and cons. And in the investment banking area, we always look at it risk management and liquidity. Employees that they have worked, according to PwC, average IPO is about 15 years. The companies that have to stay, let's say I'm an employee at the age of 20 and I have to work, I have to wait till age of 35 till I realize my opportunity or I can buy a house or a car. This is not the way that wealth management can work for private companies. So that is one of the reasons at Maxwell Rand, we looked at these issues as pain points. And the goal and objective was how do we create liquidities? So with that kind of a mindset, we decided to resort into research that led us to come into what we call NASDAQ private market. NASDAQ private market is designed, as you see, number one, for employees, as you can see. Number two is the investors. Number three are the private companies. And if you look in the bottom of the sticker, this is called Tape D, you will find all the major unicorns now are listed in this NASDAQ private market. Therefore, if you look at Canva, look at Discord, look at ChatGPT, OpenAI, all of these variations that they're coming to the marketplace, that they have all over billions in valuation, their employees right now, through this channel, have the ability to create liquidity and sell off part of their assets, okay, to the buyers. Example of that was about 10, 12 days ago, where SoftBank and Morgan Stanley teamed up and acquired $500 million worth of shares of OpenAI. These employees have decided to liquidate, but there is a disadvantage. The disadvantage is they are not going to benefit from that IPO because they sold their stocks at the pre-IPO. So the requirement and the need that you have always defines what do you want to do. And that is one of the reasons we are looking at the industrial protocol that we plan to revolutionize with what we call secondary market. These secondary markets, as you can see, there are different services available that employees, they can sell their own shares. Investors, they can buy and sell their own shares. Bank and brokers, they can buy, just like we are doing at Maxwell Rand, through our pipe. So if somebody wants to, for example, buy OpenAI shares, they cannot do that in the open market. They have to go through an intermediary, and we become one of those intermediaries through our Maxwell Rand pipe that we can acquire those shares and build it as a part of the portfolio. And then when you want to do what we call pre-direct listings, this is the time that we basically now have qualified the company for pre-IPO, which it is. And then at the time that we want to do this, we file some revisions, some accounting updates called audited financials. We submit that to the authorities through legal services. And then subsequently, we go into a protocol of IPO, and that becomes the story. But more importantly, one of the areas that, again, I like about this group is Wealth Connect. So in this kind of an issue, we are interviewing and working with different wealth managers. In fact, NASDAQ Private Market has over 500 approved wealth managers around the globe. And what is a wealth manager? A wealth manager is going to be someone who helps you to take your assets that you have, put it into a custodian account that you become the beneficiary, and they provide you with tax advice, financing, liquidity, and also making money with your money for you. Okay. These wealth managers are certified financial planners or accountants. They have licenses, they have requirements. But more importantly, as an individual, it's extremely important for you to do your own due diligence and interview them and learn about them. So the area that right now we wanted to share with you, again, is the video that it comes from MSNBC about the interview with Tom Callahan.
The IPO market, if you haven't been paying attention, has slowly been making a comeback in 2025. And our next guest works with late-stage companies on ways for their employees and their shareholders to sell their stock and for investors to actually access some of those private shares. NASDAQ Private Credit CEO Tom Callahan joins us now on set with the story. Tom, is it too far-fetched to say that private markets will come close to liquidity, the likes of which the public markets have right now?
Well, Dom, thanks for having me. And I would actually predict that in the next 3 to 5 years, the private markets could exceed, at least by one metric. So what we do at NASDAQ Private Market, as you said, are private company tenders. That's where private companies, and there's a meta trend that we need to kind of talk about here. I think everyone knows 25 years ago, there were over 8,000 publicly traded companies. Now there's half that. A decade ago, there were about 50 unicorns, private companies worth over $1 billion. Today, there's close to 1,200. So the public markets are shrinking and the private markets are growing. And so, you know, for a private company, what that means, if you want to attract and retain the best talent, and remember, a lot of these big private companies are competing against the Metas and the Googles. They need to offer employees liquidity on their shares. The average company now waits close to 15 years before they IPO. Pretty tough to say to that 25-year-old software engineer you just hired, wait till you're 40 to buy your first house. So they do tenders in order to offer liquidity to their employees.
What's been the evolution like just in the past 5 or 7 years? It's gotten huge, but you've watched it develop over the course of the past 20 or 30 years. What has been causing the massive ramp up in just like the last 5 or 7 years?
Well, let me give you some numbers on the tender business, and these are our numbers. So 3 years ago, we did about $3.5 billion in tender volume. Last year, we did about $6.5 billion in tender volume. This year, 2025, we're going to do about $30 billion in tender volume. So the market is just absolutely exploding. And I think it's a byproduct of the trend I just talked about. More private companies being more valuable. Most valuable private company right now is OpenAI, $500 billion company. That's bigger than ExxonMobil. Second largest one is SpaceX, $400 billion valuation. That's bigger than Bank of America. Third, Anthropic, $180 billion valuation. That's bigger than Citibank. These private companies are getting absolutely huge, and they have to manage their employees' liquidity. The same way that public companies offer employees shares that then, vest and they're able to sell them to live their lives, private companies need to do the exact same thing.
Tom, it's perfect timing to have you on because the secondary market's probably as hot as it's ever been. But investors that are watching, transparency, how do they get involved? Some of the risk. I know that's sort of open-ended, but speak to that.
Yeah, Guy, I'm so glad you asked that question because really big things are happening right now. President Trump just signed his executive order allowing private funds into retirement accounts. So we have tens of millions of nurses and cops and firemen that are going to be literally betting their retirements on private funds. And so you have that dynamic. The private markets are being opened up. This is an asset class that historically has been for Sand Hill Road, the most sophisticated institutional investors. Now we're letting essentially retail into these markets. So you have to know what questions to ask. And, who doesn't want to own SpaceX? Who doesn't want to own OpenAI? Who doesn't want to own Anduril? These are the hottest, most dynamic companies in the market. One thing that I always explain to people that are new to the private markets is they're different from public markets in a lot of ways, but one really important way. Public markets are bilateral. You need a buyer and seller to agree on terms, and you have a trade. If you want to buy a share of Apple, Guy, you don't need to ask Tim Cook's permission. In the private markets, you do. The company needs to approve every single share transfer. That extra step, what we say the private markets are trilateral, adds enormous complication. And a lot of the biggest and best and most dynamic private companies don't want little folks like us as investors. They only want large institutional players. So they're literally not accessible to the average retail investors. And a lot of retail investors are very surprised to learn that fact.
By having and take a listen from CNBC and Tom Callahan, I guess you heard it all. The main goal is always being able to take care of your people. Okay, wealth management is about unity of the organization, both at different tiers, but at the same time, empowering your team and your employees that they can have ways that they can enhance their lifestyles. And that is one of the reasons that private market got formed. And now in Europe, for example, meeting with the colleagues at Euronext, they are following the same NASDAQ private market to create a network and build a platform for the high-valued, mature, or companies that we call beyond J factor. And what is a J factor? It's an idea that, for example, from accounting and finance is when you start a company, you have what we call a death valley. So that's the bottom of the J. What does it mean? It's very simple that every month you're going to burn money. Okay. And that's why you got to be very conscientious as a small company, how you manage your cash flow, how you manage your business, and how you focus on your growth. Because at the end of the day, sales cures it all on one side. On the other side, equity fuels the sales to give you that. But you need to attract investors. You need to attract staff. And just like what Tom mentioned to you, is the fact that you're competing with whether it's in Malaysia or in Singapore or in United States, they're a publicly traded company. They offer incentives. So they try to pick up the best of talents. And then smaller companies suffer from that side. At Maxwell Rand, at NetStairs, at the team that we are built through Meta Exchange, we featured and we went through this pain point in the last 2 years to create Meta Exchange and build that as a vehicle for bringing the smaller companies that otherwise they would not be able to afford by themselves into a pool of acquisitions. And by the same token, now they can instantly, over a period of a time, with the permission of the company, of course, that is the most important thing. Because if, for instance, my dear colleague, Mr. Vijay, has a shareholder and decides that all of a sudden he has decided to dump the shares below the price that has been published, the company and NASDAQ will not allow that. So therefore, your valuation doesn't go down, because we all invest from the days of JP Morgan until now on potential. We always invest in future speculation. That is the essence of investment. You think about something that is going to come out. You just like you just heard OpenAI with the $500 billion valuation, right? That didn't happen overnight. That happened over decades. But when it came out, and the valuation signifies that process, and that's why investors, employees, management have ability to attract investment, as well as giving their employees the opportunities that some of them are buying mansions in San Francisco thanks to the technologies that are available in today's market. So keep in mind, without technology, we cannot really proceed any further. It's a part of our DNA now in today's modern society. But we need trust. We need something that it doesn't become this rug pull from those cryptocurrency that we want to get rich scheme, that one day we see the numbers on the terminal. The terminals that we are referring to, like Bloomberg terminal, NASDAQ terminal, private market terminals, these terminals are designed to bring with billions of dollars of investment from major investors, from Bank of America to Allen and Company and other institutions, that they have believed and betted on this process. And that is why you're going to see in the next 3-5 years, private equity becomes much larger than public. There is also an advantage for the private companies. They are not going to spend as much as time and expenditure that they are doing under public companies, with disclosure, with audits, with all of these other factors. But more importantly, it gives the company to grow its business, to get into a level that the IPO makes sense. So therefore, all of the beneficiary, including the investors from the earliest part, like your father, your mother, your sister, who gave you some money to start the project, for example, or your family members, now they can become the beneficiary of your success and creating an opportunity. But more importantly, there is one thing that I want to point out in here. Take a look at the big families around the globe. The Armani families, the BMW, the Heineken, Walmart, I can mention many other names, not individuals. Their families are not selling their shares. If they sell their shares, it's like having a lottery ticket. You went and bought a home and a car, and now you have no money. Okay. The wealth management is about a strategy. And the first thing you have to do is thinking about your own family, because you're working. And when you're working, you want the fruit of your labor that it's presenting, not only the paycheck, but also create an opportunity for your generation so you can send your kids to school, okay, to the colleges, filling up the tuition, paying up the mortgage. So this kind of things becomes what we call wealth management strategies. And there is no cookie cutter, because every individual is different. And that is why wealth management is designed to personalize that service, looking at your portfolio, looking at what you have, what they can do with you, and help you to build that in a structured, trusted format that not only you as an individual, but your beneficiaries of the future can benefit from the result of the work that you're doing today. In short, this is our presentation, that we feel that employees are a pivotal point, and along with the management, inside private companies, that when they are structured, like inside NASDAQ private market, they can give an ability to the investors, to the employees, as well as management. Back to you, Mr. Vijay. You're muted, my friend.
Thank you very much, Dr. Moradi. That was very insightful. So now that the market and the audience and everyone can know that the private market is the new way forward, it's the future of wealth strategies and wealth management strategies. So now the employees and all those investors and shareholders who have invested in the private companies can now liquidate their positions through the Nasdaq private market. So it was very, very exciting and a very insightful session today. And that wraps up this edition of Tech Talk. We have seen how smart, forward looking wealth strategies can empower both executives and employees to take control of their financial journey while creating sustainable growth. Thank you for tuning in, and be sure to join us next time as we continue exploring ideas that shape the future of business, finance, and technology. Thank you very much.
Cheers. Take care.